the question where there are MCQs, there are 10 or rather 8 MCQs, and the last two questions of question number 1 are short questions that require short answers. The first one, select the best answer for question number 1.1 to 1.7. Write the number of the selected answer in your answer booklet along with the number assigned to the question. Which of the following statements are correct with regard to the code of best practice of corporate governance? First one, the chairman and CEO of the company cannot be the same person. So they want us to give the correct answer, correct statement. Which of the following statements should be correct? The chairman and CEO of the company cannot be the same person. Now, you know the Sri Lankan best practice of corporate governance, this is principle based. What do you mean by principle based? It's not a law. You need to comply. If you can't comply, you need to disclose. You should disclose not only the fact that we have not complied, also you need to disclose the reasons for non-compliance. Now we know in the best practice of corporate governance, the chairman and the CEO should be two different personnel, two different individuals. But in certain instances, the chairman himself can be the CEO. If that is the case, you should disclose the fact that the same person is holding the chairmanship as well as the CEOship, and also you need to disclose why it is so, and so this statement is not correct as a result. So they want us to give the correct answer, correct statement. For companies listed in the Dirisavi board, the board should have at least 3 non-executive directors. Now we have 2 boards basically, Dirisavi and main board, and the minimum number of non-executive should be 3, that is also correct. A director is independent if he holds not less than 5% of voting shares of the company. And what the corporate governance says is, if a director is holding not less than 5%, he is not deemed to be independent. For him to be independent, it has to be less than 5% shareholding. So that is also wrong. A director is independent if he carries a transaction or transactions equivalent or less than 5% of the total turnover of that company. And that is what is more appropriate in the given scenario. So the answer has to be D. If you go through the criteria given in the corporate governance booklet to assess the independence, you can find this out, and you anyway have to bring the corporate governance booklet to the exam hall. If someone has entered into a material transactions is not a transaction of fulfilling the materialistic requirements. If it is a transaction which is of a substantial magnitude, and then that is considered to be a material transaction, normally it is 5% threshold. So then the answer has to be D. Why? This particular director is having a material transactions, a transaction which is of a significant magnitude, that is 5%. That is how you assess it. And here the director cannot be considered to be independent because he has a material transactions. What do you mean by material transaction? Transaction which is of a significant magnitude. So the answer for 1.1 should be D. (1.2) On 31st March 19, it was discovered that damage to the machine was worse than what was expected. The machine is now considered to be worthless, and the recoverable amount of the factory as a cash generating unit is estimated to be 900,000 rupees. As at 31st March 19, the cash generating unit comprises the following assets: building 500, plant and equipment included the damaged machine at a carrying amount of 45,000 rupees 345, goodwill is 55, non-current assets at recoverable amount 200. Under LKS 36, what will be the carrying amount of ABC's plant and equipment when the impairment loss has been allocated to the cash generating unit? And before you answer, you need to do a bit of a calculations in order to arrive at the figure. I must do some explanations as well. Normally, if a CGU is considered to be impaired, LKS 36 specifies an order in which the impairment loss is allocated to the assets in the CGU. And if you have assets like inventories, you can't allocate. If you have financial assets, you can't allocate. If you have defined benefit plan assets, you can't allocate. If you have biological assets carried at fair value as cost at the point of sale, you can't allocate. If you have deferred tax assets, you can't allocate. If you have investment properties carried at fair value, you can't allocate. The total carrying value is 1,100. Recoverable value is given as 900. So, the impairment loss is 200. Normally, under normal circumstances, I will tell you why it is exceptional here. Under normal circumstances, the impairment loss of a CGU should be allocated to the goodwill. But even before you start allocating the impairment loss to the goodwill, there is another pre-requirement. What is it? If a particular asset is individually impaired, maybe as a result of accidents or a collision, if a particular asset is individually impaired, even before you allocate the impairment loss to the goodwill, please remember you need to allocate impairment loss to the asset which is individually impaired. So, that is what the question says. There is a plant which is damaged and it's beyond repair, and you need to fully de-recognize it. So, of this 200,000 impairment loss, now buildings 500, plant and equipment 345, goodwill 55, net current assets 200, total is 1001. 900 is the recoverable, so the impairment loss is 200. Out of 200, you first allocate 45 to plant and equipment. So, this is remaining now out of 200, remaining impairment loss is only 155. Then this 155 should be allocated now to the goodwill first, and the remaining should be to the buildings and to plant and equipment, remaining plant and equipment of 300 on pro rata basis. So, out of 155, let me allocate 55 first to the goodwill. So, the goodwill becomes 0. Plant and equipment is now 300, buildings 500, remaining impairment is 100. This remaining impairment now gets allocated to buildings and plant and equipment on pro rata basis. How does it work? You take plant and equipment 300 divided by 800 into 100. So, let us work it out. 300 divided by 800 into 100, 37.5. So, you allocate 37.5 for plant and equipment. 300 minus 37.5 is 262.5. What is the answer? It has to be A, 262,500. Number 3, Which of the following will be treated as a subsidiary of parent PLC as of 31st March 18? The acquisition of 80% of the Albion equity share capital on 1st March 18, Albion activities are significantly different from the rest of the plant PLC group of companies. Now that is bit of a fallacy. Now sometimes back, long time ago, so there was a fallacy and a misunderstanding that if the business of a particular company of a group is dissimilar to the rest of the companies in the group, that particular company need not to be consolidated. I am not talking about the requirement of SLFRS 10 now. I am talking about the misconceptions and the fallacies, misunderstandings that were there a long time ago. Now, if say a particular parent company is a garment manufacturing company and they have some other subsidiary company that carry out related and similar businesses. One company will be manufacturing buttons, another company will be weaving fabrics, another company will be supplying accessories, and another company will be supplying thread, and so on and so forth. So all these companies are interrelated, they are in the related business as of the parent company. So there can be another company which is also a subsidiary company of which the business activities are completely different from the rest of the companies within the group. One company is like pumping air to the parachutes and the balloons. So the practice long time ago was that a subsidiary company whose business activities are dissimilar should be excluded from the consolidations, and it's not taken into the group in doing the financial statements of the group. And those misunderstandings and fallacies are no longer available, even if the business of a particular member in the sense a subsidiary company, say, may be dissimilar and different. Just ignore it in spite of that, and we will consolidate that as well within the group. So now company Albion acquired equity, the parent company has acquired Albion a 60% equity. The business activities are dissimilar, so that's all right. Let the business be different, that's all right. And disregarding that, this company can be considered to be what? A subsidiary company. Number 2, the offer to acquire 70% of Summon PLC's equity share capital on 1st November. And these are not my questions. Remember, these are the pilot paper questions. Summon PLC's equity share capital on 1st November 17, the negotiations were finally signed off during June 2018. Still, it is only at the stage of being negotiated. One company has offered and the parent company has started, maybe it is in the still process at the pipeline, and the discussions are underway, so not finalized, and the parent company has still not acquired the control. So without the control being acquired, there is no subsidiary company. Just leave it. Number 2 cannot be taken. The acquisition of 45% of Janat's PLC's equity share capital on 31st December 17, 45%. I don't think with 45% you can apply control even with de facto power under SLFRS 9, no, SLFRS 10 rather. And it is further confirmed that parent PLC is able to appoint 3 of the 10 members, not. So they must have the significant influence, not the control. So as a result, which of the following will be treated as a subsidiary of parent? It's only the parent, only the first one. So the answer has to be one only, that is A. A has to be the correct answer. Fourth one, the following 2 issues relate to Abacon PLC mining activities. Issue 1. Abacon PLC began operating a new mine in January 19 under a 5-year government license that required Abacon PLC to landscape the area after mining ceased at an estimated cost of 500,000 rupees. So they have to create the provision. And they are under a contractual obligation to carry out landscaping, carry out require rectification work and activities end of the mining period. Issue number 2, during 18 and 19, Abekon PLC mining activities caused environmental pollution to an adjoining piece of government land. No legislation requires Abekon PLC to rectify this damage. However, Abekon PLC has a published environmental policy which includes assurances that it will do so. The estimated cost of the rectification is 1 million rupees. Even if there is no legal requirement, even if there is no legal obligation, since they have been having the practice of doing that, since there are business activities that have affected to another party, now these practices which this company has been having over the period will make them liable to do the required rectifications. Now they need to recognize a provision in the second one as well. What is the question? Under case 37, provisions contingent, liabilities contingent assets. Which of the following statements are correct in respect to the financial statements for the year ended 31st March 19 of Abekon PLC? A provision is required for the cost of issues 1 and 2. Correct. Both issues 1 and 2 require disclosure only. Wrong. A provision is required for the cost of issue 1 but issue 2 requires disclosures only. Wrong. Issue 1 requires disclosure only and issue 2 should be ignored. So the correct answer should be A, that is 1.4. Correct answer should be A. Which of the following may not be capitalized as part of the cost of Abekon Development PLC's new head office? The retirement benefit cost of Abekon Development PLC's employees who were involved in building the head office should be the employment benefit cost, whether it is post-employment or whether it is terminations or whatever, irrespective of the category of employment benefits, the employment benefits of the employees who directly got involved in the construction of the asset should be included to the cost of the asset. So the first one should be included. The cost of identifying an appropriate site for the head office, architect's fees, cost of removing the old property on the chosen site. Now B is bit of a contentious one. Why? The cost of identifying an appropriate site for the head office. So that particular item cannot be included. One thing is we haven't still started the process of preparing the asset to the required level. Now, you know, you have to start preparing the asset to the required level of the user. So without you starting preparing the asset to the required level of the user, you cannot include any cost to the cost of the asset. Architect's fees, yes, it has to be included. Why? It is a directly attributable cost and this is a required cost to prepare the asset to the required level of the user. Cost of removing the old property on the chosen site. Very obvious. I mean, without you doing that, you can't prepare the asset to the required level. So the correct answer should be what? B, the cost of identifying an appropriate site for the head office. If you were to explain the reasons for choosing, that turns the answer. It's not the requirement now. But if in a narrative kind of a questions, if you were to give the reasons, explanations for using that, what would you write? It is a cost incurred before you started preparing the asset to the required level. 1.6. On 1st April 18, Sayumi PLC borrowed 10 million for a 1-year term. So, need to do some calculations there. $10 million borrowed. For 1-year term exclusively to finance the constructions of a new piece of production equipment. So, this is not to finance anything else, but to finance the construction of the equipment exclusively only for that. The interest rate on the loan is 15%. 15% interest rate, and this is payable on the maturity of the loan. The construction commenced on 1st July 18. 1st July 18, the commencement of the construction. But no construction took place between 1st December 18 to 31st January 19. Over 2 months' time, the construction has not been continuing due to employees taking industrial action. Would have been a strike. The asset was available for use on 28 February 19. 28 February 19. With a construction cost of 10 million, the cost incurred has been 10 million, fine. Production equipment depreciates 12% on cost annually. The opening ceremony for the production equipment was held on 1st April 19. What is the carrying amount of the production equipment in the statement of the financial positions of Sayumi PLC of 31st March 19? The carrying value is the value where the asset is recognized in the balance sheet statement of financial positions on the reporting date. So, apparently this entity would have adopted the cost model. So, before you decide the carrying value, you need to do 2 tasks. What are those 2 tasks? You need to complete the cost calculations and then depreciate and see what the carrying value should be. So, let me first take the cost. The cost incurred is 10 million, fine, but that is not the final bottom line. Why? We need to apply case 23 as well. Why? This is a qualifying asset. How do we know? It takes a substantial time period, fine. Then interest cost incurred on the borrowing of the asset should be added under case 23. Now, you need to do the calculation. You need to decide the period. Now, the construction commenced on 1st July 18, fine, and the asset became available for use on 28 February 19. You know, some dates, different dates will be loaded with some redundant excess information will be loaded just to mess up, and the examiner can set the trap and you will get caught. You need to be smarter than the examiner thinks you are. You should be smarter not to get caught, and you need to pick only the information that you think is necessary in the scenario. So, LCAS 23 requires you to stop capitalizing borrowing cost when the asset becomes available for use. Opening ceremony and parties and functions, those are just nonsense. They have got nothing to do with LCAS 23. What you need to look at is whether the asset has been prepared and taken to the level intended by the management. That was done on 28th February. So, that is it, and you need not to look at anything else. Just to complicate y'all, the examiner can, that is the nature of the examiner, he will give as much information as he thinks should be given. That is up to the examiner, but you need to be smart. Now, it has to be starting from 1st July 18 to 28th February 18. But during this period, the construction has been suspended for 2 months period, and that was due to technical reasons or a non-technical. The way the question is worded, it is a non-technical reason. Labor actions, I mean industrial actions, obviously seems to be a strike. So, how many months should be taken as the period for which the borrowing cost need to be capitalized? We need to capitalize starting from July, August, September, October, November, December, January, February, altogether 8 out of 8 months. We will ignore 2 months and it will be only 2 months period. So, we will work out on interest 10 million into 15% divided by 12 into 6. $10,000,000 into 15, it is 750,000. 10,000,000, 750 should be the cost. To calculate the carrying value, you need to depreciate it for how many months? You need to depreciate that for 1 month period. 1 month, it became available for use on 20th February. So, this is divided, this is into 12% divided by 12 into 1. Take the depreciation. 10,750,000 into 12% divided by 12. Then 10,750,000 minus 107,500. 10,750,000, 1,064,000, 10 million rather, 10,000,000, 642,500 should be the carrying value. So, the answer has to be D, 10,642,500 should be the carrying value. 1.7, Lasanti Water PLC has a 75% investment in Pure Water Limited. Which in turn has a 60% investment in Dream Water. Dream Water 60%. Sakuni Pereira is the sales director of Lasanti Water. Sakuni, sales director. And her husband is the chief operating officer of Gaia Homes. Sakuni's husband. Is the CEO of Gaia Homes PLC. Gaia Homes PLC. To which of the companies is she related as per case 24? Now, Sakuni is a member of the key management of Lasanti Water. Directors ensured, the members of the key management ensured directors of the entity are related parties. But if the entity has subsidiary companies, the directors of the entity are considered to be related parties of not only of the entity being concerned, also the subsidiary companies of the entity being concerned. Now, Lasanti Water PLC has 2 subsidiary companies, Pure Water Limited and Dream Water. So, Sakuni is a director or rather related party of these 3 companies by and large. Then Sakuni has her husband. Husband is a close family member of Sakuni, and husband is a director, or not a director, I mean member of the key management of Gaia Homes PLC. Then husband, Sakuni's husband is considered to be a related party of Gaia Homes. Husband, he himself and his close family member of husband, he himself and his close family member should also be related party of Gaia Homes PLC. Now, Sakuni is not only related, Sakuni is considered not only to be related parties of these three companies, also Gaia Homes PLC. What is the answer? To which of the companies is she related as per case 24 related party disclosures? Lasanti Water PLC wrong. Lasanti Water PLC and Gaia Homes PLC is wrong. Lasanti Water PLC, Gaia Homes PLC and Pure Water Limited wrong. Lasanti Water PLC, Gaia Homes PLC, Dream Water and Pure Water Limited. So, the answer has to be D. 1.7, the answer has to be D. Fill in the blanks using your calculations and select the most suitable word from the words given within brackets. For question number 1.8 to 1.10, write the answer for the blanks and selected word in your answer booklet along with the number assigned to the question. A company acquired shares in a trading partner on 1st September 18 as part of a long-term strategy to gain significant influence. The cost of the investment was 250 million rupees and transaction costs amounted to 10 million rupees. The shares had a fair value of 265 million rupees on 31st March 19, the amount recognized in the statement for the year ended 31st March 19, if the company makes the available selection regarding the measurement of shares is, let us do a simple calculation first. Now, the investment was made with the intention of acquiring significant influence, then you can apply equity method, forget about that stuff. The examiner seems to focus not on LKS 28 but on SLFRS 9. If it is an equity investment, you need to see where and how the investments are classified and measured. Now, apparently, the intention of acquiring the investment is to acquire significant influence, and this is a long-term strategy. Then, this equity investment, which is a long-term strategy, has to be under fair value through OCI. Initial measurement should be fair value, and if there is a transaction cost incurred, you need to add it to the carrying value. Subsequent measurement should be fair value. Fair value changes are recognized to OCS. That is what has to be the accounting part of it. Very simple. Initially, they have invested 250 million, that is what is considered to be the initial fair value. Transaction cost is 10 million added to the initial carrying value. The shares had a fair value of 265 million. Closing measurement should be fair value 265. So, there is a fair value change of 5 million and it has to be recognized to OCI. So, in first blank A, the answer has to be 5 million, and the blank second one B, it has to be OCI, not to profit and loss. So, a simple one. (1.9) Chandima Limited operates a defined benefit for its employees on 31st March 2019. The company was advised by actuaries that the fair value of plan assets was 20.5 million rupees. The present value of the defined benefit obligation was 17.4 million rupees, and the present value of future economic benefits in relation to the plan were 2.5 million rupees. The amount recognized in the statement of the financial position of Chandima Limited on 31st March 19 in respect of the defined benefit plan is rupees. Right. So, let us do a small calculation. And this is from LKS 19 defined benefit plan asset ceiling. And on the reporting date, the carrying value of the defined benefit plan should be either the present values of the future, the carrying value of the defined benefit plan should be the lower of the present values of the future, refunds and the reductions of the contributions, and the difference between the plan assets and the plan liabilities. Now, on 31st March 19, assets were 20.5 million, assets 20.5. Present value of the defined benefit obligations were 17.4 obligations. Then the balance is 3.1. Either this or the present values of the future economic benefits in form of reductions in contributions and refunds, that is 2.5. 2.5. So, the value has to be the lower value. This is the value to be recognized now in the financial statements. 2.5 is the amount, and this has to be an asset. So, the first blank has to be 2.5, second blank should be asset. So, 1.1. Panorama PLC acquired 750,000 shares out of 1 million. So, it is going to be a control acquisition with a percentage of 75%. On 1st April 18, immediately making a cash payment of 250 million. That would have been obviously the cash consideration. And deferred consideration of 100 million payable on 31st March 21. Acquisition date was on 1st April 18, and this deferred payment becomes payable on 31st March 21. So, how many years ahead? 19, 20, 21, 3 years, and this deferred consideration of 100 million should be taken to investment at its fair value. Fair value should be the present value after being discounted at the market rate of interest. 1.1 to the power 3, 100 million divided by 1.1 to the power 3, 75.13. Deferred consideration. At that date, the carrying amount of the net assets of Samoa PLC was 350 million. Net assets 350 million. And the market value of a share in Samoa PLC was 370 rupees. That is given to measure NCI at fair value. If you take NCI at fair value, non-controlling shareholders are holding 250,000 shares and the market price of a share is 370. 250 into 370 is 92,500, 92.5. 92.5. What is the good value of goodwill that arises on the acquisitions if the NCI is measured at fair value? Let us close up this cost of control account and finalize the goodwill calculation. This is 3, this is 6, 7. 417.63 minus 350, 67.63. 67.63, it has to be 67.63 the answer for the last item of question number 1. So, we can proceed. Question number 2 we discussed before, and even question number 3 was discussed before, and let us go to question number 4 now. You have been given the following information on Sun Solar Power Private Limited concerning the current and the previous financial years. 31st March 18, 31st March 17, current ratio 2.05, 1.85, quick ratio 0.8, 1.11, debtors collection period 35 days, 28 days. Creditors payment period 29 days, 31 days. Inventory turnover period 106 days, 70 days. Required, assess the liquidity position and efficiency of Sun Solar Power Private Limited using the above information. Discuss the main aspects of an integrated report according to the IR framework. Right. Let us start with A. Assess the liquidity and efficiency of Sun Solar Power Private Limited, the above using the above information. Let me first take liquidity. Now, in a simple business context, for you to make money, you need to keep some amount of money on your hand. And if I get an order from a customer, and if I have to finance the purchase of materials, finance the payment of labor, and to finance the payment of overheads, if I do not have enough money on my hand, what should I do? Either I need to go for a bank loan or a bank OD facility or packing credit facility. And if your name of the company has been blacklisted everywhere and no one wants to give you any support financially, you get isolated and you have no option but to refuse or to reject the order from the customer. And if you could accept the order, the profit figure would have been 100 million. Since you are not having adequate cash on your hand and you are not in a position to accept the order from the customer, and then you are losing 100 million profit. To earn that 100 million profit to the company, you need to keep some amount of cash on your hand, and that depends on the nature of the business. Nature of the business has to decide what working capital requirements are. Now, to assess the liquidity, you normally use two ratios, current ratio and the quick assets ratio, and they are given with the comparative figures. Current ratio has been 1.85 in the last year. It has moved up from being 1.85 to be 2.05. Right. Now, normally what is considered to be the benchmark, rather than it being the benchmark, what is considered to be the accepted norm of the current ratio. So, once again that depends on the industries. It will be different from industry to industry. Normally, by and large, what is normally accepted is that an entity need to have 2 times of current assets. One current asset will be utilized to pay off the short term liabilities, and the balance 1 rupee current assets will be utilized to make business in the future. That is what is, it's not a hard and fast rule, that is what is normally accepted. Now, company seems to have moved from bit of a poor situations to a better situation. Why? Company has progressed from 1.85 to 2.05. So, apparently if you take the current ratio in isolation, that seems to be good, but you need to compare it with the other ratios. My opinion can be different as we slide down in the other ratios, and for the moment apparently the company seems to have progressed over the year from 1.85, from being 1.85 ratio to 2.05. Quick ratio, last year it was 1.11, now it is 0.8. How is the quick ratio taken? Normally, current assets are taken after eliminating non-liquid assets. What are non-liquid assets? Even if you look at the balance sheet, which is arranged according to liquidity preference, the first asset to be recognized under current is inventories, and the last item is the cash and bank balance. And if you see the distance of inventories to cash and bank balance, that is far away from cash and bank balance. The chances of debtors being cash and bank is very high than the chances of inventories being cash and bank. Now, current ratio has progressed, but quick ratio, now before that, how do we take quick ratio? Current assets minus basically inventories divided by current liabilities. Now, current ratio has progressed over the year, but quick ratio has deteriorated. Normally, the quick ratio is considered to be should be a 1 ratio. I mean, the accepted norm of the quick ratio is 1 time. You need to have 1 quick assets for 1 current liabilities, and that is where we were basically, and we were moving around where we were supposed to be, but now we are going from bad to worse. It was 1.11 before, now it is 0.8. Why? Now you can realize for yourself that included in current assets are inventories, and the major part of current assets seems to be inventories. If you remove inventories from current assets, the current assets seems to be even smaller than the current liabilities. So, here the current asset seems to be of a major component. Then you need to decide why the inventories would have been a major item. Couple of reasons can be there. Either they have introduced a new product, and as soon as you introduce the new product, you can't impress that to the customer. That takes some time, and then the inventories keep accumulating and you can't help it. Or inventories may be obsolete. Some inventories are obsolete and you can't make the customer buy your inventories. Or else inventories are damaged. If the inventories are damaged, you can't sell. Whatever the reason it is, inventory seems to have accumulated over the period 1 year's time. Then debtors collection period. 28 days was before, now it is 35. Even the debtors collection period has come down, and we have given extended 7 days. Now when the period is extended, that shows less efficiency or more efficiency? That shows less efficiency. So we are moving from being good to be bad. We were good before 28 days, now we are 35 days. So we are going from bad to worse. Your efficiency level is now decreasing. Why? We used to collect within 28 days, now we are collecting in 35 days. Obviously you will have some liquidity problems, and this is the budding situations of liquidity problems, pullulating. Now they are emerging, the primary stage of liquidity problems. Then creditors payment period. Now things are further aggravating. Why? We used to settle the creditors in 31 days, now 29. So we are speeding up the settlement to creditors and slowing down the collection from the customers. Nobody can stop you from getting into a imminent financial mess. Very soon, immediate, just in few months time, maybe in few weeks time, you will get into a financial mess. Inventory turnover, it was 70 days, now 106 days. You can see what has happened now. Here 70 days, it has been extended by how many days? 36 days. 36 days. Inventories are turning very slowly now, very slowly, and we are pushing the we are settling the suppliers very fast, but we are slowing down the collection from the customers. So we are having imminent financial difficulties. More or less, your entire working capital management efficiency level has dropped. We have dropped our efficiency level in debt collection. Also, we have lost our efficiency level in inventory management as well. So that is what you need to highlight. What do we highlight now? Under liquidity, current ratio has progressed, but that is because of deterioration of efficiency level in inventories. It is obvious now, and that will get reassured from the next ratio, quick ratio. It was 1.11 before, now it is 0.8. The biggest element in your current assets has been inventories. Once you remove inventories out from current assets remaining balance seems to be a smaller amount. Now we will come to a conclusion that some of the inventories are either obsoleted, or some of the inventories are damaged, or this entity would have introduced a new product to the customers, and that does not become so impressive as soon as you introduce, and that would have been one reason. Why? To impress the customers, to make the customers buy our product, we would have extended the collection period from 7 days. So now current ratio, though it looks good, does not seem to be good in this scenario, because current ratio has improved because there are outdated, damaged, obsolete inventories. So the current ratio does not show a better position. Quick ratio has gone from bad to worse, and we have just 0.8 quick assets to cover up 1.11 current 1 worth of current liabilities, and we are going from bad to worse as far as quick ratio is concerned. So liquidity position does not seem to be the best, does not seem to be as good as it's supposed to be in this organization. Then efficiency, debtors collection has dropped. We have extended by 7 days, maybe because if you introduce the new product to the customers to impress the customers about the new product, we would have given some benefit to the customer. You guys have to pay us not in 28 days, in 35 days, extended. That can be one reason. Creditors payment period, efficiency has increased. increased from 31 days to 29 days, but it's affecting adversely to the entity. Why? We are slowing down the collection but speeding up the payment to the creditors, and our financial liquidity problems are imminent, immediate. Why? It is affecting, there can be a dual impact in this decisions of extending the collections and speeding up the settlement to the creditors, right. So, that will start draining of our cash balance. Here slowing, inflows are slowed, outflows are speeded up, and that will dry out our cash balance, drain off our cash balance. Creditor settlement period we have discussed, and inventory turnover, the worst is that extended by 36 days. That is where we need to be careful. Why? Because there can be either new products introduced and you have to penetrate to the market quickly, or damaged goods, or obsolete, and then that is what that has increased the current ratio a big to a big level, and the efficiency level by and large has decreased from 31st March 17 to 31st March 18, right. So, we can move on to the main aspects of an integrated reporting according to IR framework. It would have been IIRC, International Integrated Reporting Council. You know, learning financial accounting was a conventional one. Financial reporting was a conventional, traditional concept. Now, we should, in addition to doing the financial reporting, also there should be non-financial reporting as well. Non-financial reporting as well. From the financial reporting, we can report only on quantitative aspects of the business, but you know, for a business to sustain, in addition to be having financial statistics, sustainable, solid financial base, also we need to have some values in a business. So, how do we report these values of a business to the readers of the financial statements, the stakeholders of the financial statements, and that is where integrated reporting will play a big role, right. Now, this is the latest development in non-financial reporting. We had environmental reporting, we had reporting on CSR, then it became like sustainability reporting. The latest development was integrated reporting. This is also called triple bottom line reporting, or P3, people, profit and planet. Now, here discuss the main aspects of an integrated reporting according to IIRC. Now, they talk about capitals, and this IIRC integrated reporting framework introduces 6 kinds of capital. 6 kinds of capital: financial capital, then manufacturing capital, manufacturing capital, intellectual capital, and human capital, social relationship, and natural resources. I am just giving you a few examples. Financial capital, no problem, you know what it is. But social relationship, I am telling you, your net assets, your net worth, or the net worth of a business should be its network. Net worth of a business should be its network. Just imagine, you being a chartered accountant after being graduated, you were fostered, nurtured by your parents in isolation. No friends, no colleagues, no companions, and no one is known to you, neither do you know anyone. And if you want to find a job, how hard it can be. But if you have a strong network, you know everyone everywhere, just at a ring cut, they know who you are. And finding a place to work at is not so hard. Likewise, whatever you want to do, your network will decide what your net worth should be. And if you do a business of online business, your net worth will be your network. Social relationship will be a capital. So, without limiting your understanding to understand that the capital should be only the financial capital, the understanding of integrated reporting expands their understanding to the extent of social relationships being understood as our capital. Then, human capital. You know, the best asset, the most important and the precious asset of an organization will be the people. And you cannot run a business without the people. The people are the kind of aspect of the business who will push this company forward. Natural resources, say if you generate power using water, hydropower, so can you make money without having natural resources? Cannot. Even if you say you are a manufacturing entity where you take the power from the national grid. So, how does the national grid generate power for your business using natural resources? So, aren't you consuming natural resources to keep your business going? Yes, you do. Even that has to be a capital. So, these are the capitals which integrated reporting understands, and IIRC gives aspects of the capital, and that also reports on how these integrated reporting shows how this will be creating values to the organization, creates value to the organization, that gives the guidelines, that gives the definitions of capital, that also gives the contents of integrated reporting. And you can read the answer, the suggested solution, if my explanation was not that enough. Integrated reporting links social, environmental and ethical performance to financial performance and aims to fulfill the reporting gap between annual reporting and business values. It is sometimes referred to as triple bottom line reporting, 3P, profit, planet and people. Integrated reporting is the latest development in corporate social responsibility reporting. This takes sustainability reporting a step further by linking it to financial performance, right. The IIRC issued the integrated reporting framework in 2013. Its aim in doing so was to accelerate the global adoptions of integrated reporting. There are three main aspects of an integrated report according to the IIRC framework: capitals, guideline principles and content elements. Capital refer to the types of capital as inputs to enter a business model that a firm uses to create value. All organizations depend on various forms of capital for their success. including financial, manufactured, intellectual, human, social relationships and natural capital. These capitals increase, decrease or transform through the activities and outputs of the organization. The capitals are interlinked. For example, human capital increases through the provisions of employee training, but financial capital decreases due to the cost. Guiding principles are guidelines set out for the preparations and presentation of an integrated report. Content elements are the information required to be included in integrated reporting. So, we move on to question number 5. Question number 5. The following situations are relevant to Sashila Engineering Holding PLC for the year ended 31st March 19. You are handling the following situations as reporting accountant of SHE PLC. Subsidiary fair value adjustments. When completing the consolidated financial statements, the director has suggested that there should be no positive fair value adjustments for a recently acquired subsidiary and has stated that the accountant's current position is dependent upon following these instructions. The fair value of the subsidiary company is 500 million above the carrying amount in the financial records. The reason given for not fair valuing the subsidiaries net assets is that goodwill is an arbitrary calculations that is meaningless in the context of the performance evaluations of an entity. Goodwill impairment calculation. When preparing the annual impairment tests of goodwill arising on other subsidiaries, the director has suggested that the accountant is flexible in the assumptions used in calculating future expected cash flow, so that no impairment of goodwill arises, and that the accountant should use a discount rate which reflects risks for which future cash flows have been adjusted. He has indicated that he will support a salary increase for the accountant if he follows his suggestions. Required, discuss the ethical and accounting implications of the above situations from the perspective of the reporting accountant, right. So, there are two issues given. Now, also there are two expectations by the examiner. Subsidiary fair value adjustment. Right. We will talk about accounting implications plus the ethical aspect. When completing the consolidated financial statements, the director has suggested that there should be no positive fair value adjustments for a recently acquired subsidiary company and has stated that the accountant's current position is dependent upon following these instructions. Now, the director requires not to recognize the fair value adjustment for the newly acquired subsidiary company. The accountant's current position is dependent upon following these instructions. There is kind of an intermediation. The accountant is under the threat and the influence of the director. The director intimidates the accountant to follow his rules, follow his advisors, and not to follow the required accounting treatments and prescriptions of SLFRS 3. Then the fair value of the subsidiary acquired recently has been higher by 500 million above the carrying amount in the financial record. The reason given for not fair valuing the subsidiary's net assets is less, is that goodwill is an arbitrary calculation that is meaningless in the context of the performance evaluations of an entity. Now, if you fair value, the property, plant and equipment will increase, and then that will require extra depreciation to be recognized into the financial statements of the group. And then if you take the EPS calculations, extra depreciation will bring down the profit of the company, and that profit figures will bring down EPS calculations of the company. If it is a listed company, or listed companies try to keep their EPS as high as possible just to impress the investors to buy our shares. So that part is there, and that is the accounting part of it. I mean, the accounting implication seems to be that, but SLFRS 3 requires if you recognize a subsidiary company, you need to fair value net assets. Why? If not, you are not complying to the initial measurement requirements of other standard. What I am saying is this now. Subsidiary company has 100,000 worth of property, plant and equipment in the books, and their fair value is 150,000. Parent company acquires subsidiary company. What if the parent company acquired only the property, plant and equipment of the subsidiary company without buying the business itself? Then the parent company will pay 150,000 rupees, and parent company would buy property, plant and equipment, and the cost of property, plant and equipment would have been how much? 150,000. Unless the parent company recognizes the fair value of property, plant and equipment of the subsidiary company on the acquisition date, the property, plant and equipment on the acquisition of the business will get recorded at 100,000. Now, depending on whether you purchase only property, plant and equipment separately, or whether you purchase property, plant and equipment along with the business, the cost of the properties will be different. Then there is no uniformity. I hope the point was clear. There is no consistency. So the IFRSs, SLFRSs were developed in such a way to maintain consistency and uniformity, whether you buy them separately without buying the business, or whether you buy property, plant and equipment right together with the business, the cost has to be the same. Then the cost has to be 150. For the cost to be 150,000, whether you like or not, you need to revalue property, plant and equipment on the acquisition date, and that is a must under IFRS 3. Now the ethical aspect, there is kind of an intimidation. The director intimidate the accountant, threatening. The accountant seems to be under objectivity. It's a complete breach of objectivity. He is under the influence of the director not to follow the requirements of SLFRS 10 and SLFRS 3, but to follow the instructions of the director. And he has to have some remedies. What are the remedial actions? He can take assistance from the institute, the professional body where he is a member, and he can take the support from the technical department and get the department to advise the director on the implications of not applying IFRSs. And then he can take even legal actions, and sometimes, and if he can even take the matter to the people like whistleblowers, and if nothing works, the final solutions will be the resignations without discrediting the profession, and you need to do that. So that is the ethical part of it. Now, if the accountant is following the instructions of the director without following the required accounting treatment and prescriptions of SLFRS 3, SLFRS 10, it is a complete breach of objectivity. You are biased, you are not independent, and you will be impartial, you are partial to one party, you are free from, you are biased to one particular party. That is the ethical part of it. So, the ethical aspect of objectivity has been breached if you start following the instructions of the director, and the accounting implication is this: SLFRS 3 requires the assets to be measured at fair value. If not, we violate the initial measurements of other standards like LK 16, LK 38, SLFRS 9, and so on and so forth, and based on that the goodwill has to be calculated, and those are the accounting implications, right. And let me see the suggested solution of answer 5. Positive fair value adjustments increase the assets of the acquired company and as such reduce the goodwill recognized on consolidation. However, the majority of positive fair value adjustments usually relate to its items of property, plant and equipment. As a result, extra depreciation based on the net assets net fair value adjustment reduces the post acquisition profits of the subsidiary company. This has a negative impact on important financial performance measures such as EPS. Therefore, by reducing the fair value adjustments, it will improve the apparent performance of new acquisitions and the consolidated financial statements. Accountants should act ethically and ignore undue pressure to undertake creative accounting in preparing such adjustments. Guidance such as SLFRS 3 business combinations and SLFRS 13 fair value measurement should be used in preparing adjustments, and professional value should be engaged where necessary. In measuring value in use, the discount rate used should be the pre-tax rate, which reflects current market assessments of the time value of money and the risk specific to the asset. The discount rate should not reflect risk. That part is important. The discount rate should not reflect risks for which future cash flows have been adjusted. For which future cash flows have been adjusted. And should equal the rate of return which investors would require if they were to choose an investment that would generate cash flows equivalent to those expected from the asset. By reducing the impairment, it would have a positive impact on the financial statements. The offer of a salary increase is inappropriate and no action should be taken until the situation is clarified. Inappropriate financial reporting raises issues and risks for those involved and other associated with the company. While financial reporting involves judgment, it would appear that the situation is related to judgment. There are several potential breaches of accounting standards and unethical practices being used by the director. The director is trying to trying to force the accountant into acting unethically. LK's 1 presentation of financial statement requires all standards to be applied if a fair presentation is to be obtained. Directors cannot choose which standard they do or do not apply. It is important that accountants identify issues of unethical practice and act appropriately following CA Sri Lanka Code of Ethics. The accountant should discuss the matters with the director. The technical issues should be explained and risks of non-compliance explained to the director. If the director refuses to comply with accounting standards, then it would be appropriate to discuss the matter with others affected, such as other directors, and seek professional advice from CA Sri Lanka. Legal advice should be considered if necessary. An accountant who comes under pressure from senior colleagues to make inappropriate valuations and disclosures should discuss the matter with the person suggesting this. The discussion should try to confirm the facts and the reporting guidance which needs to be followed. Financial reporting does involve judgment, but the cases above seem to be more than just differences in opinion. The accountant should keep a record of conversations and actions and discuss the matters with others affected by the decision, such as directors. Additional resignation should be considered if the matters cannot be satisfactorily resolved. So, that is what I explained before, and they have given the same thing in bit of a detailed manner. So, we are moving on to section 3. In section 3, the question number 6 was discussed, and we are moving to question number 7. Dream Holding PLC is a diversified company listed in the Colombo Stock Exchange, and you are its finance manager. The company has business around the world. The following matters need to be properly addressed to finalize the financial statements for the year ended 31st March 19. Required calculations need to be provided where necessary to support your explanations, recommendations, advice. First one, sales contract. DHP has entered into a sales contract for the construction of an asset with a customer, whereby the customer pays an initial deposit. The deposit is refundable only if DHP fails to complete the construction of the asset. The construction company should refund it only if DHP fails to complete the construction. The remainder is payable on delivery of the asset. If the customer defaults on the contract before completion, DHP has the right to retain the deposit. The managing director believes that as completion of the asset is performed over time, revenue should be recognized accordingly. He has persuaded the accountant to include the deposit and a percentage of the remaining balance for construction work in revenue to date. Second one, property, plant and equipment. DHP changed the measurement basis for land and buildings from the cost model to the revaluation model from 31st March 19. DHP shows land and buildings as two separate line items in its financial statements. Based on the valuation of land and buildings carried out at year end, the remaining useful life of the building was reassessed as 25 years. This is 5 years more than the remaining useful life based on the original assessment. The following information is extracted from the financial statements. 31st March 19, land buildings cost 8 million, buildings 30 million. Accumulated depreciation as 31st March 19, buildings 15 million. Written down value as 31st March 19, land 8 million, building 15 million. Fair value as at 31st March 19, land 7 million, buildings 18 million. Manufacturing facility and head office. DHP is committed to a plan to sell its head office building and on 31st March 19 had engaged the services of an agent to locate a buyer. DHP Industries is having a new head office constructed and will use the existing building until the completion of its new premises. When DHP Industries vacates the property, the existing head office will be transferred to a buyer. Segment reporting. The results of the regional segments for the year ended 31st March 19 are as follows: revenue, segment results, external internal, profit or loss, segment assets, segment liabilities. Europe 200, external internal 10, loss 15, segment assets 500, liabilities 200, Asia 300, external 15 internal, profit 30 million, assets 600 million, segment liabilities 150 million. Other regions, external 380, internal 5, profit 25, segment assets 450, liabilities 170. There were no significant intra-group balances in the segment assets and liabilities. The company sets individual performance indicators for each region. Required under the Sri Lanka accounting standards SLFRS 15, revenue from contracts with customers discuss whether revenue arising from the sales contract should be recognized on a stage of completion basis. Now, first part, sales contract, if you go through the contents clearly say the seller, the manufacturer himself is the seller, he takes a deposit initially and the remainder will be collected by the seller and the manufacturer only on delivery of the asset. And these deposits will be refundable only if the manufacturer fails to complete the construction. If the customer defaults, the seller will not only retain the asset, also has the right to retain the deposit. Then the directors are under the impression that they should recognize revenue over the period because they are under the impression that the performance obligations are satisfied over the period. Now, this is the construction of an asset and the question does not specify what the asset is. Now, in SLFRS 15 you apply some criteria to realize whether the performance obligations are satisfied over the period. And if the control of the asset passes to the customer instantaneously, as the asset is created, the control of the asset passes to the customer. If that is the case, you can recognize revenue over the period because the performance obligations are satisfied over the period. Second, if the customer consumes the asset or the service as the asset is created, then again the performance obligations are considered to be satisfied over the period and you can recognize revenue over the period. And if the seller does not have an alternate use to the asset and has a right not to the asset but to the payment, and then again the performance obligations are satisfied over the period and revenue should be recognized over the period. But none of those requirements seems to be satisfied here. What does it say? The customer does not receive the control of the asset as the asset is constructed, as the asset is created, and the customer gets the asset and the control of the asset at the end. And not that does the customer consume the asset. As the asset is created, the customer gets it at the end. And the way the question is worded, the customer does not, or rather the seller does not have retained the right of retaining the, I mean what I am saying is, apparently the seller, the way the question has been worded, the seller seems to have an alternate use to the asset, because he can retain the asset. Why does the seller retain the asset? What makes the seller retain the asset? Because he can either use for himself or he can sell it to another party. If the customer does not pay, the seller has the right to retain the asset and the deposit. Why does the seller retain the asset? What makes the seller retain the asset? Because he can use it for himself or he can sell it to another party, and that emphasizes the fact that the seller has an alternate use. So, none of the requirements are satisfied to evidence that the performance obligations are satisfied over the period. No, the performance obligations are satisfied at a particular point in time. So, revenue should be recognized at that particular time when the control of the asset passes to the customer. That is the point at which the seller, the construction company, should recognize revenue. So, we are moving on to number 2. Let us look at the requirement of the examiner first. Second one, explain the financial reporting impact of changing the measurement basis for land and buildings and the useful life of the buildings based on the information provided in 2 above. DHP changed the measurement basis for land and buildings from the cost model to the revaluation model from 31st March 19. DHP shows land and buildings as 2 separate line items in its financial statements based on the valuation of land and buildings carried out at year end. The remaining useful life of the buildings were reassessed as 25 years. This is 5 years more than the remaining useful life based on the original assessment. The following information is extracted from the financial statements. Cost land 8 million, accumulated depreciation 31st March 19 0, written down value as at 31st March 19 8 million. Buildings cost is 30 million, depreciation 15 million, written down value 15 million, fair value 18 million. Now, measurement basis has been changed. Now, a change over from cost model to revaluation model should be a change in accounting policies. So, basically, if you decide to change over from one measurement basis of assets and liabilities to another basis of measurement of assets and liabilities, that is normally considered to be an accounting policy change. That is one way of explaining the change of accounting policies in a simple language that you and I understand. And if you change your accounting policies, you need to apply LKS 8. What does LKS 8 say? If it is an accounting policy change, you need to apply it retrospectively. What does it say? You need to apply the new accounting policy of property, plant and equipment being measured using revaluation model from the year this particular land and building size, you need to apply the new policy of revaluation model for land and buildings from the year in which you started using cost model. Then you need to restate your comparative informations, and if adjustments are required for the periods before comparative periods, those adjustments are adjusted to the equity items at the beginning of the earliest comparative period. Then how do we do this? Land cost is 8, written down value is 8, as at 31st March 19, fair value is 7 million. So, there is a fair value loss of 1 million, and the question does not speak about the fair value changes of the previous years, and you need to be happy with what is given in the question. And if the examiner does not give you the fair value changes of the previous periods, please shut your mouth and be happy with what is given. Don't start crying for what is not given. Please satisfy yourself with what is given. So, this 1 million fair value changes, decreases are recognized to profit and loss under LK 60. So, those are the important points to be included in your answer. The measurement basis changes, the changes relating to measurement basis of assets and liabilities are considered to be accounting policy changes. Then accounting policy changes are done using retrospective applications of LKs 8. Then here the changes of the previous periods are not given. Then the change of 1 million, and this is a fair value decrease from 8 million to 7 million, should be recognized to profit and loss under LK 60. Buildings carrying value is 15 million. And the fair value is 18 million. So, there is a fair value increase of 3 million, fair value increase of 3 million. Again the previous year's fair value changes are not given. Then what you must do is to account only the current year's fair value changes of 3 million. This has to be recognized to OCI, should be recognized to OCI. So, there is another change. The estimated lifetime of the building as at 31st March 19, 31st March 19, estimated lifetime is 25 years. And this 25 years reassessed lifetime is longer by 5 years than the originally assessed lifetime. Then the changes of the lifetime of the asset should be an estimate change. Estimate changes are adjusted, recognized prospectively, and you need not to get back to the previous years. So, then you need to calculate the current year depreciations and the depreciation for the future of the buildings by considering 25 years newly assessed lifetime. So, this is done prospectively from the current year to the future. So, what you must include in your answer relating to building should be that revaluation gain arising from the building should be recognized to equity OCI, and the lifetime being revised from the previous to the new one should be an estimate change which is recognized prospectively to profit and loss. I mean to the current year and to the future periods. We are moving on to number 3, and let us look at the requirement of the examiner. Assess whether the manufacturing facility and head office can be classified as held for sale. Let us go through the contents of number 3. DHP is committed to a plan to sell its head office building, and on 31st March 19 had engaged the services of an agent to locate a buyer. DHP Industries is having a new head office constructed and will use the existing building until the completion of its new premises. When DHP Industries vacates the property, the existing head office will be transferred to a buyer. The question is given from SLFRS 5. What is it? Non-current assets held for sale and discontinued operations. There are no discontinued operations, but there is an asset held for sale. Building. You categorize a particular non-current asset under held for sale category if you can confirm that the asset will be held only to recover the carrying value asset from the sales proceeds in a single sale transaction, and this asset does not contribute to any other cash flows, will contribute to a cash flow of being sold in a single sale transaction. And for you to confirm that a particular asset contributes only to a sale transaction, contributes only to the sales proceeds of a single sale transaction, you need to look at a lot of criteria. And I won't explain everything, let me explain the criteria which is not satisfied in this example. What is it? DHP is committed to a plan, fine, to sell his head office building, all right, 31st March 19, and they are in the process of receiving the services of an agent to locate a buyer, fine. Most of the conditions, requirements are fulfilled. DHP Industries is having a new head office constructed and will use the existing building until the completion of its new premises. Now, even if the company is in the process of finding a customer, or rather a buyer, to sell the building to existing building, they will hand over the building to the buyer. In other words, they will complete the sale transaction only after shifting to the new building, of which the constructions are still in progress. And who knows whether the construction of the new building will take another 4 years to complete. And who knows whether the construction of the new building will take altogether another 10 years to complete. So, nobody knows and nobody is sure about it. As a result, the entity DHP will not be able to complete the sale transaction of the existing head office building until such time the construction of the new building is complete. The new building construction does not seem to be immediate, that will take couple of years. So, the sale transaction of the new building does not seem to be immediate, there is no immediate sale transaction. So, you can see the answers, and if the sale transaction is not immediate, you cannot apply SLFRS 5. So, this asset cannot be classified under SLFRS 5 assets held for sale. Answer 1 for question number 7. At the inception of the contract, Dream Holdings PLC must determine whether its promise to construct the asset is a performance obligation satisfied over time. Dream Holdings PLC only has rights during the production of the asset over the initial deposit paid. They have to they have no enforceable rights to the remaining balance as construction takes place. Therefore, they would not be able to receive payment for work performed to date. Additionally, Dream Holdings PLC has to repay the deposit should they fail to complete the construction of the asset in accordance with the contract. There is a single performance obligation that is only met on the delivery of the asset to the customer. Revenue should not be recognized on a stage of completion basis but must be deferred and recognized at a point of time based on delivery of the asset to the customer. Answer for part 2. As per LK's 8, the initial application of a policy to revalue assets in accordance with LK 16, property, plant and equipment is a change in accounting policy and should be dealt with as a revaluation under LK 16 rather than in accordance with the standard. Therefore, change in the measurement basis for land and building should be accounted as follows. A fair value reductions in land amounting to 1 million rupees should be recognized in profit or loss. The fair value gain in the building amounting to 3 million rupees should be recognized in other comprehensive income and equity under the headings of revaluation surplus. Change in the remaining useful life of the building is a change in estimate and should be recognized prospectively. Accordingly, the fair value of the building of rupees 18 million should be depreciated over 25 years. This will result in depreciations for the year of 0.72 million. Third one, a non-current asset is classified as held for sale if its carrying amount is to be recovered principally through a sale transaction rather than through continuing use. For this to be the case, the asset must be available for immediate sale and its present conditions, its sale must be highly probable. The head office shall not be classified as held for sale as the delay in transferring the property to a buyer demonstrates that it is not available for immediate sale in its present condition. Then we are looking at the fourth part of the question. Segment reporting. The results of the regional segments for the year ended 31st March 19 are as follows. Revenue internal plus external, segment results, profits and losses, segment assets, segment liabilities are given, Europe, Asia, other regions. There were no significant intra-group balances in the statement. In the segment assets and liabilities, the company sets individual performance indicators for each region. We will look at the requirement of the examiner. Discuss how the principles in SLFRS 8 operating segments for the determination of a company's reportable operating segment should be applied for DHP using the information given above. Now, SLFRS 8 talks about two segments. First, operating segments. Second, reportable segments. Now, you need to first identify operating segments, from which you then identify reportable segments. For a particular segment to be an operating segment, you need to look at three criteria. It has to be a component of the entity and should engage in business activities and has to generate revenue and should incur expenses. Then the chief operating or chief operating decision maker of the entity has to review their financial statements, to review their performances in order to decide whether to allocate some more resources and to decide how much more resources to be allocated. Third, there should be discrete financial information. In other words, there should be separate financial statements for each segment. And having identified operating segments, then we continue to recognize reportable segments. To identify reportable segments, there are 3 thresholds given. You need not to apply, for a particular operating segment to be a reportable segment, that segment need not to satisfy all the 3 thresholds, just one is enough. You need to make sure that the revenue of a particular segment, operating segment, is 10% or more of the combined revenue of all the operating segments. Or the profit or loss of a particular operating segment should be higher, should be 10% or more of the higher of the absolute amount of profits and losses, absolute amounts of profit and losses. The third one, the assets of a particular operating segment should be 10% or more of the combined assets of all the segments. So now there are segments given, the segment should be the geographical segment, so that is all right. Now first we will calculate the required threshold why all the 3 segments, Europe, Asia and other regions, appear to be operating segments. Why? Because they seem to be component of the entity and they engage in business activities, obviously yes, and they generate revenue and incur expenses. That is why they have revenue and that is why they have profit and loss. And somebody must be reviewing, somebody means the chief operating decision maker must be reviewing their performances and statistics to take various decisions. And then discrete financial information is available. Yes, it is available in the question. Now obviously all these 3 segments can be considered to be operating segments. It's only just that we need to identify what and what of these should be reportable segments. To identify the reportable segments, you need to apply the thresholds. First threshold, revenue. In calculating the 10% threshold, you can apply external, internal both. Europe, total 210. Asia, it is 315. Other regions 385. Total 910. So make sure my calculations are correct. 210 plus 315 plus 385, 910. Take the percentages. 210 divided by 910 into 100, it is 23%. This is revenue. 315 divided by 910 into 100, 34.6. 385 divided by 910 into 100, 42. Then segment results. You need to take the total of the profits of the segments that only made profits. Also you need to take the losses of the segments that made only losses. and take the totals of these absolute figures without netting off, and then take the higher figure, then the profits or the losses of each segment should be declared as a percentage on the higher of the profits of the segments that made only profits and the losses of the segments that made only losses. Now, the profits of the segments that made only profits should be 55. Losses is 15, the higher figure is 55. So, we will take only 55. Europe, 15 divided by 55 into 100, 27.27. Asia, 30 divided by 55 into 100. You need not to do because all the segments have become reportable segments by now. 30 divided by 55 into 100, 54. Other regions, 25 divided by 55 into 100, 45.45. Other regions, 25 divided by 55 into 100. And other assets, segment assets, you take the assets, not the net assets, segment assets, 500 plus 600 plus 450, total should be 1550. So, 500 divided by 1515 to 100, 600 divided by 1515 to 100, and 450 divided by 1515 to 100, and then you can take the percentages. Now, all these become the reportable segments. Now, there is another requirement. The selected reportable segment should report at least 75% of external revenue. That requirement is there. Now, what is the external revenue? External revenue is 200 plus 300 plus 380, and you can see the percentage of the total revenue. At least 75% requirement should be included. So, by applying the thresholds 10% profit or loss, 10% assets, 10% revenue, you can identify the reportable segments. Now, all the segments are what? Reportable segments. So, that is how we identify the reportable segments and operating segments of SLFRS 8, and that is the end of our discussions of the paper, and also the end of our webinar series. And thanks for watching our videos of webinars, and hope you all will be able to perform at the exam well, and our videos would have been helpful for you all. And all the very best, and we should extend our heartfelt gratitude for CS Sri Lanka for organizing and hosting this program, and Mr. Suraj for giving us the technical support. Thank you.